So we're a touch early. For anyone who doesn't know us, I'm Ben Walker, the founder and chartered accountant here at Inspire, and I've got Riz, one of our family accountants, with us as well.
Hey guys, let me just shut this door.
For anyone who doesn't know us, I'm Ben Walker, the founder and chartered accountant here at Inspire. We've got Facebook Live going crazy. Here we go. So yeah, just if anyone doesn't know, we are going live on Zoom, but also at the same time that's publishing through to Facebook. So cool. And thanks, Bradley, for letting us know you can hear us.
That's awesome.
Cheers.
Yeah, if any time throughout that, if the mic drops out or if anything like that, please do let us know. Yeah, just shoot us a message through the chat and it should be all good. Might just wait a couple of minutes for everyone to roll in a little bit, man.
Yeah.
Yeah.
That's it. Oh.
See how we're going.
Pop that up. Thanks, Mark, for letting us know. Alrighty, so hopefully everyone can see our screen. And yes, so welcome to our webinar all about making your BAS work for you. So what we often refer to is BAS is often seen as a deadline or something that sort of pops up every quarter, and it's almost like for us business owners, we don't know, or it just pops up out of the blue, but we obviously know that every BAS has a due date, and we know it's every quarter, but often it's a little bit unexpected like that. So we're looking in this webinar to explore how we can turn that BAS deadline into a business lifeline.
Yeah. It's just taking advantage of that time each quarter, or whenever your BAS is due, to give yourself a little bit of a check on how you're going throughout the financial year. Yeah, I'm really excited to be sharing this with you guys, and I hope you guys enjoy it.
That's it. And if you didn't hear before, who are you?
Me. My name is Riz, and I'm one of the family accountants here at Inspire. So what I do here at Inspire is I take care of our Inspire family clients, and what I do is I make sure they get the most out of Inspire. So I'm there to be the go-to person to make sure they, I answer all their questions and make sure we save them as much tax as possible. And yeah, that's pretty much what I do. And what I've done before previously is actually work for a firm where I do the bookkeeping for many of the small businesses in Brisbane, and also a little bit of tax and accounting as well. Through that experience, it's allowed me to really understand the grassroots of the moving parts behind all these businesses and how they all work. And I'll be using those skills today to share you on how you can look at your zero file, your bookkeeping file, and make the best out of it.
That's it. That's awesome. And I think Riz actually saved his clients an average of about $18,000 in tax the financial year that's just finished. Yeah. So super impressive skill set there. And if anyone didn't, so if anyone missed my name is Ben Walker, and I was the founder of Inspire about 4.5 years ago now. Yeah, so why don't we get right into it. So there's not only just me and Riz in this business, we've got a great team, and you can see that on the screen now. Yeah, so we're based over in West End, just outside of the CBD in Brisbane. And yes, this is our awesome team. That brown guy in the middle is Harvey Penny, my business partner. Yep. And we've got Catherine Ali Riz on the left, and Jake and Reggie over on the right.
Yeah. And I can see down there you guys have been featured in quite a bit of stuff. And even before I started joining Inspire, I was really attracted to all the stuff that you've been published and stuff like that. So do check us out. We are published in quite different areas in the social media world. You also won an award for the best Cool Business Award last year as well.
Yeah, the Cool Company.
Cool Company, sorry.
Yeah, that's it. So we've got a few podcasts that we've been featured on in the Courier Mail, and actually this next one here is we were sort of called one of the top 100 cool companies in Australia, and that's not something. Cool is not usually something that you hear associated with the word accountant.
Yeah, so when I first met Ben, he definitely changed the stereotype of what accounting and accountant means, and it's definitely been proven through accolades like Cool Company Awards and working with him every day. It's just been working here, so cool, you know, as cool as we can be.
That's it. And what really caught the attention of Anthill, who gave us this award, was actually our campaign we ran, and that was in 2016. And our aim through that campaign, it was 12 weeks, and our goal was to save our client base $500,000 in tax. And so that's part of the service that we do when we work with our clients each financial year. And we've got a video. Yes, $500,000 in tax savings is pretty cool, but let's hear from Kenny, the guy in this video, exactly what that meant for him. So
it's probably one of my favorite videos.
That's it. And as we go, just checking the chat box. Cool. Good. So I'm going to switch over to the video.
Thanks to Ben and the team at Inspire CA. This year we've got $38,000 back. $38,000. What we're going to save? $38,000. $38,000. Do you know what I can do with that? My family and I can actually go on holiday the next year we didn't think we could afford to. So now we can. I can give some back to the church. Look, it's amazing what we can do with it. Thanks, Ben and the team at Inspire.
Thank you, Kenny. That's probably my favorite video. It's just the enthusiasm of it all. $38,000.
We got definitely some great feedback from that video, but we also got some negative feedback where Kenny did take his hands off the wheel. But anyway, that's Kenny. And what we ended up doing was the total number we saved our clients, and this surprised everybody, like every single person in the working with Inspire. We actually saved our clients $1.26 million in tax in just that 12 weeks alone, so more than doubled our target.
Yeah, and I think during that time I was just about to enter Inspire, and I've been following them, listening to this story as they announce how much tax they're saving as they go by closer to 30th of June, and they hit 1.2 million. I was just thinking, wow, this is something that is definitely commendable, and I'd love to be part of that. And when I joined Inspire, this is what we did this year as well, didn't we?
Yeah, exactly. And we'll, actually, we're in the war room here at Inspire. Basically, this is our tax savings war. I'll just hide this screen for a sec so you can see it. But behind us on the wall here are all of our impact statements from the 2017 year, so the one we've just finished, 2017 Save Tax campaign. The goal there was another $1 million in tax, so we doubled our target from last year, and we ended up hitting 1.097 million in tax. So again, smashing it out of the park. So
great time of year, this one here.
Yeah, and I mentioned that we do that service for every single client that we work with, and that's part of our It's All Sorted tax and accounting subscription, which aims to pay for itself in tax savings. And it's perfect for business owners who are turning over $300K to $3 million in revenue, and they're looking to create a business that gives them the freedom to put family first. So that's some of our clients on the right-hand side there. The Taylors, and then we've got the Flynns there, and also Will and Willow on his shoulders there.
What a cutie.
So
that's a little bit about us. Yeah. So what we've been doing last year, what we've been doing so far, It's really exciting times, and we're here at Inspire. We're always trying to make sure that we can provide even more value to you. So one of the things that we'd like to do with you guys today is this webinar, make BAS work for you. It's not just, a lot of accountants, they go through the financial year and they go and look at businesses once a year. Businesses don't start and end just once a year. I don't think so. You do have to do things every quarter or every month to make sure everything's on track. And one of the things that we saw in terms of touch points with your accountants that we usually have is this thing called BAS. And that's a great opportunity to actually do a lot of cool stuff, like check for tax, check for how you're going and stuff like that. And yeah, we'll go a little bit deeper on that today.
Yeah. So we're going to run through, first of all, we're going to run through the 5 common BAS mistakes and how you can avoid them. We're also going to go into about knowing your numbers as well. So that's something that we're super passionate about here, and numbers are like the scoreboard of business. If you're playing a game of rugby, for instance, and you can't see the scoreboard or how you're doing, how do you know if you need to turn it up or whether you're comfortable and you're in the lead? Yeah, I mean, that's what we're looking to do. And we're also going to wrap up the webinar talking about your numbers A team. So the people you need in your business financial world who are going to help you with all of this stuff. And before we get into those 5 common mistakes, I thought, Riz, we could have a look at an actual BAS.
Oh, wow.
What do you reckon?
I'd love to. Which BAS are you thinking of sharing then?
Well, I can't share any clients.
I was just going to say.
I can't share a client's BAS, but what I could do is actually share one of our own. So basically pop up one of our own BASs or Inspire's BASs. And this is...
I haven't seen this. Even I haven't seen
the Inspire BAS?
No.
Well, this is the second...
But by the way, you're sharing this about Inspire. Wow, thank you so much for being really transparent here. Even I haven't seen this. Yeah, it's cool.
So what I've got up on the screen now, I hope that's coming through nice and clear, is the second ever BAS that Inspire lodged. And that was in the June quarter, we call it.
Right.
But the period between the 1st of April 2013 to the 30th of June 2013.
Got it.
Now, a lot of people think that BAS is just like the GST or some sort of tax that they pay every quarter. But what I'd like to share is there's actually quite a number of taxes that play into a BAS. And I think there's actually 4 that can come in there. The first one is GST. Pardon me. The first one is GST, and that's GST that you might charge your customers, that you have to pay to the ATO. And we've also can claim the GST that we pay suppliers. Things like the subscriptions that we pay, or marketing agencies or accounting fees. If they're based in Australia, then they're most likely going to charge you GST, and you can claim that back from the ATO. Another tax on your BAS is actually pay-as-you-go tax withheld. That's that one there at number 4 that Riz is highlighting, so pay-as-you-go tax withholding. And that's the amount that you withhold from your team members when you pay them a salary.
Right.
So you might pay them, $1,000 a week, for instance, but the ATO says that you've got to take out tax before you pay them the net amount. And so this, your BAS is where you have to pay that amount to the ATO. And the final tax that you have to pay on a BAS is also a pay-as-you-go in tax installment.
That's not on here.
Yeah, that's actually a very good point. Now, it depends on how your business is structured if you actually have to pay a pay-as-you-go installment. And Inspire back in 2013 was structured as a trust. And we're going to dive into business structures in a little while. But the short answer is trusts don't actually pay tax themselves.
That sounds too good to be true.
It is a little bit, Riz, but we could explore why.
Yep, absolutely.
Trusts also don't have pay-as-you-go income tax installments because those installments are actually tax that the ATO has estimated you owe for the year, and they're charging you in advance of you actually lodging your tax return. So again, when we're looking at BASs, we must have a look at how much that pay-as-you-go income tax installment is, if it exists.
Yeah, so that's the forward that you're talking about.
Yeah.
So when you launch that BAS, you're reporting to the ATO, hey, this is how much GST I've collected from my customers. This is how much GST that I'm gonna claim because I've paid for it, and also how much tax I've been withholding on behalf of my employees. And lastly, if I have a PAYG installment, that's something that I pay every quarter or whenever your BAS is due.
Exactly right.
Is it safe to say that we can assume that in this webinar we're going to talk about quarterly BASs? It's easier to go forward like that?
Yeah, that's a good question. Now, there's most businesses in Australia actually have to lodge a BAS on a quarterly basis. Now, that's where the business is turning over more than $75,000 in a year, that they have to lodge that quarterly. And the other thing we've got to consider is, do you pay GST when you receive the money or when you raise the invoice? And that's this thing up here called GST accounting method, cash. And the other option is non-cash, or sometimes we call that accruals. Sounds pretty cruel.
Thank you, man.
You've got to have some dodgy accountant jokes. But yeah, most business owners, the best option to choose there is the cash basis. Now, the reason that's the case generally is when you raise your invoices, if you're on an accruals basis, as soon as you raise your invoice, that's when you need to pay the GST, or that's the quarter that it relates to.
Even if I don't receive the cash yet.
Exactly right. But as business owners, we know that how often the second we raise an invoice do we receive the cash. It never happens.
I wish it was.
Exactly right. Otherwise, we're just invoicing all day. So the alternative is cash. So, and how that works is when GST hits your bank, that's when you have the obligation to pay your GST. So if it takes 90 days, for instance, to get paid on average, which is not a great sign, by the way, then you're not paying GST for money you haven't even received. So that's why cash is usually a great idea for business owners.
Yeah.
Now, shifting down the BAS, up the top here, we've got the summary. So that's the summary of the GST on the sales, or the amounts you owe the tax office. We've also got pay-as-you-go from employees, and that's the total amount I owe the tax office. And then we get to claim the GST on purchases, so that's that amount there. And so for this June quarter, my payment was $3,643.
Got it.
Now, we break it down into a bit more detail as we go down this report, and we actually tell the ATO exactly how many dollars of invoices we raised in that quarter. So we're getting pretty transparent with the good old tax department.
Oh wow! Is it 79 million? Oh no, 79,000. Just checking.
A few zeros short of $1 million there, but yeah, it's second bad. But we also need to tell the ATO how much purchases we have here.
Yeah.
Now we've got capital purchases here and non-capital. Riz, would you be able to sort of explain what is a capital purchase?
Yeah, sure, no problem. And it's a really accounting word to say capital and stuff like that. It's very easy. It's easy for me to say capital purchases. What that means is it's something that is not an expense immediately. So what that means is if you buy big assets like a car or equipment or even furniture and stuff like that, that's considered a capital purchase if it's big enough. And the differentiating aspect of it is, does it last a long time, or does it last, within a year and it gets used up? What that means is, for instance, if I was to hire Ben as an accountant and he does a tax return for me, that cost is not capital. It doesn't last a long time. It's a non-capital.
Okay.
So that's the two different points here. So if you see that you have capital purchases, from what I can see, Ben, you just started the the business, you may have bought $6,000 worth of, I don't know, laptops.
Laptop, yeah. That's probably what it was around then.
So what that says is, look, we've got capital purchases of $6,000, and then all the other expenses is $63,000, non-capital purchases, things that don't last long, essentially.
There you go. Okay. Thanks for sharing that.
That's okay.
And if we sold stuff overseas or exported stuff, that's where that would go in export or GST-free sales.
Yeah, it's funny. It's actually interesting, man. Like, we're seeing this, and this is a little bit outdated because it's 2013, but the ATO is actually trying to simplify all of this right now. And what we're looking at is, you see all this mumbo-jumbo stuff that we're reporting to the ATO, they're actually cutting it down, and they're making it really simple.
Is this all they want to know now?
That's it. Yeah. They just want to know, because if you see, that is the bottom half is the breakdown of where all the numbers come from, and that's actually the dollar amount that you have to pay to the ATO. What the ATO is saying now in the going forward is, look, we don't want to know much about this. We want to know exactly how much you owe us.
And we don't want to know anything else.
We don't want to know anything else, exactly. So they're simplifying the BAS reporting just to save time as well. And so which is a good sign for small businesses.
Yeah, and so I think that's for, is it businesses turning over $10 million or less?
Correct, yes.
They get the simpler rules. So that's pretty handy. Alrighty. Now, so yeah, we're kind of talking a little bit outdated here, but the other things that are commonly reported on BASs, if I go down to the next page, are the pay-as-you-go tax withholding. So also letting the ATO know how much you paid in salaries to your employees, and then the amounts that you withheld in tax to those employees. So that's what those two figures, the W1 and W2 are.
So that's the breakdown of the number on top just then.
That's exactly right.
Okay.
And we've got some payment details down here. Now, anyone, if you can see those BPay details, feel free to make a payment to our BAS on our behalf. We won't say no.
Thank you so much.
Yeah, so that's what a BAS usually consists of. And as Riz said, the simpler reporting means the BAS, instead of being, I think this is a 3-page document, it'll be even on 1 page.
So that's kind of like what a BAS is. And the reason why we go through that is we have an audience of different knowledge levels in our audience today. And there'll be some people who see a BAS and they just go, look, don't tell me, just make the payment. I don't want to know. But what we're trying to kind of uncover today is what a BAS is and where those numbers come from and why they're important. Because just paying them is great. If you can make the full payment, no worries, it's great. But also in this webinar, what we want to explore is taking that opportunity of preparing the BAS to kind of self-check and kind of put your finger on the pulse and go, is my business going okay? How am I traveling along? And also, am I on track to achieving my targets and goals? So that's one of the things that we'll discover in this webinar.
Awesome. Well, we're going to dive into the first of 5 common BAS mistakes and how you can avoid them.
Yeah.
Now, number 1 here is, my favorite, I guess. Not my favorite because it's fun, but my favorite because there's things that you can do to avoid paying too much tax.
Absolutely.
So what we mean by paying too much tax on a BAS is sometimes you're not actually claiming as much GST as you're entitled to. Now, we can see that if you're incorrectly, something's happening in the bookkeeping and you're not actually claiming the GST in there, or things like you're actually charging GST to an overseas client where you may not necessarily have to charge that GST.
Yeah. So that comes, the devil's in the details actually, because that comes to good bookkeeping practice. And what we see sometimes when we take care of our clients' BASs is we make sure that the bookkeeping is correct and what's obvious that has GST to be claimed or to be collected on is coded as GST. When you have a bookkeeper, or if you do bookkeeping for yourself, you have to make sure that your bookkeeping practices are on the money, because it literally translates to paying too much tax. Absolutely. So it is worthwhile. We'll talk about having a bookkeeper later on, but it is worthwhile to have someone professional doing it, because I've seen cases where you're paying way too much tax just because you bookkeep that was an error in bookkeeping. And also one of the big things I see currently is actually people not claiming tax. Are we talking about that in the next bit?
Yeah. No, I think this is the too much, and then we've got not that.
Okay, so there's a bit where, you know, I've seen some people who import stuff, right? So when you import into Australia, you have to pay this thing called customs GST. So what it does is it levies a GST on all the supplies or materials that you buy from overseas, and it levies the minute it lands in Australia. What's funny is you're paying all this GST that you can claim in your BASs. And I've seen personally where it's thousands of dollars of GST that was not properly booked yet, because it's a bit more complex, that transaction. And because the client didn't have a proper bookkeeper, it was kind of going, oh, I've just paid that and there's no GST claimed on that. And what we found was there was thousands of dollars of unclaimed GST that we got back for them. And that just kind of like opened up my mind to, wow, what else is happening out there where people are paying way too much tax just because they didn't bookkeep something right.
Yeah.
You know what I mean? Yeah. So that's one of those things there. And you said that there was 4 different types of tax, right, Ben?
Exactly.
Yeah. So that we were just talking about paying too much tax
in GST.
In GST.
Now, there's another one that people often pay too much tax of, and that's the pay-as-you-go income tax installments. And I mentioned that before when we're looking through the BAS, and that's where the ATO says, all right, you earned 200 grand last year, you paid $50,000 in tax. Now, we think you're going to make the same amount again next year. So we're going to charge you a quarter of that every 3 months, a quarter of that $50,000, almost prepaying your tax for the next financial year.
Yeah, because the ATO doesn't like you having a tax bill.
No, that's right. Their goal is that when you lodge a tax return, you don't have to pay tax, but you don't get a refund. So you just pay the right amount.
Yeah.
And that's what their intention is with this.
Yeah.
My personal belief and experience from what we've seen is that more than 50% of business owners are actually paying too much tax.
Because the assumption, I think personally, the assumption of the ATO saying you're going to make X amount or more next year, it's a bit of a naive assumption. Just saying that businesses will be the same or growing going forward. You're all business owners, you tell me. It's different every year, and you have to assess how much tax you have to pay ongoing. It's not just, hey, the ATO told me to pay this, so we'll pay this amount.
Exactly. And you can actually, if you're earning more or less than what the ATO thinks you are, you can actually vary how much you pay each quarter. The other interesting thing is I mentioned that more than half business owners out there are actually paying too much tax. We know that because we offer this product called a look under the hood, and that's a second opinion on if a business owner is paying too much tax. And so if you are paying too much tax, then the ATO are going to tax you already way too much than what you should be paying.
Correct.
So that business owner who paid 50 grand when they should have paid 30, the ATO are still going to charge them as if they should be paying 50 grand or more.
Correct. Yeah. So you're tying up your money basically with the ATO very early on in prepayment. And when tax time comes, it shows that your bill was actually 30,000, not the 50,000 that they thought it would be, and you get this refund. So the funny thing is, a lot of people celebrate refunds. You know, I'll leave that for you to think about whether a refund is a good position to be in or not. That just means that you paid the ATO a bit too early.
Exactly.
That's what it means.
That's it. Alrighty. Number 2, a common BAS mistake, and that is not paying enough tax. Now, I've actually seen a couple of situations where people haven't been registered for GST, but they've needed to be registered for GST. And when you need to be registered is when you're turning over $75,000 in a year or more. Now, another common mistake there is that people think you have to turn over 75 grand before you register for GST. Well, if you predict that you will turn over $75,000 or more in the next 12 months, then that's when you need to register for GST. So we've seen a couple of clients who've come to us and they're turning over maybe $150,000 and not even registered for GST. They just kind of forgot about it. And the process there, and it hurts so much, is that they actually owe 1/11 of that money that they've received to the ATO, and that can really bite and hurt down the track.
And I think that's on the GST front, right?
Yeah.
You're not paying enough GST there, where you're meeting the threshold, but you're not registered for GST. I think coming back on the PAYG installment, remember when I say PAYG installment, just think prepayment of tax, that's it. So coming back on the PAYG installment, which is one of those 4 things that we pay in the BAS, you can also not pay enough tax. And everyone goes, what are you talking about, Riz? We don't want to pay more tax. Yeah, correct. But we're in the business of making sure that you pay the right amount and fair share of tax that you deserve. So underpaying tax is a bad thing as well, because what that means is you're not prepaying enough for the future. So what that means is when tax time comes, we lodge your tax return, hey, do you have a $20,000 bill? And that's not fun as well.
Yeah.
More so, we'd love for you to be able to plan and budget for the fair share amount of tax that you should be paying to the ATO. So not paying enough tax is a problem as well.
Yeah, that's it. Awesome. And it kind of goes back to the bookkeeping as well. Like if you're incorrectly doing your bookkeeping and you're kind of you're overclaiming what you're entitled to, that means you're actually not paying enough tax. And that can come back and bite if the ATO or someone comes back, looks through your books and discovers, whoops, you haven't actually paid enough. And so this could be years later and you have a nasty bill, which is actually a nice segue into the third mistake, third BAS mistake. And that's actually not setting aside enough tax.
Yeah, and just giving clarity to this, it means not setting enough cash for your tax bills. That's exactly what this means.
That's it. And often we hear from people looking to change accountants is that what causes them is surprises, and that could be surprise bills from their accountant, or that could be surprise BAS bills from their accountant. The BASs are due, like the June BAS that's due soon is actually due. I think it's Friday.
This Friday, sorry. Yep.
Friday the 25th.
Sorry, Friday 25th.
Yeah. Next Friday.
Getting my weeks mixed up.
And so what the feedback we get is that accountants are getting, or bookkeepers are getting the BASs out to the business owners on the day before or 2 days before it's actually due, or sometimes on the day or later. So that's not cool. But what's really not cool is that business owner is kind of unaware of exactly how much BAS they've got to pay. And when someone sends you an email saying, here's your BAS, oh, by the way, it's $20,000 and it's due tomorrow.
I'll run and hide for a bit.
Exactly. And you haven't actually set that money aside, that $20,000 aside, then that is really going to hurt.
Yeah, this is the point in time where if this webinar was live, I would love to ask how many of you have ever been in that position where, hey, here's your BAS bill, and we kind of go, and then you kind of go, oh crap, I don't have enough set aside there. And we found that this was such a fundamental problem, especially in small businesses where cash is such, it's so valuable. It's not just, it's the lifeblood of the business, and not having that aside, not having that meeting up. I don't want to talk about the business going down or having cash flow issues up to that point. But the main thing is the stress, the stress of, oh my gosh, I have this BAS bill. I don't have enough cash.
Absolutely.
And that's definitely one of the biggest mistakes here, not setting enough cash aside.
Yeah, no, that's it. And some strategies to combat this mistake is at Inspire, we actually recommend our clients set up a separate bank account, and that's their tax account. And each week or a couple of times a month, they actually put or allocate a certain percentage of what comes into their business and puts that into their tax account. And then around comes BAS time, they get the bill from the accountant and it says $20,000. And tell us about what Amanda said.
She sent me a text. I think it was text. Yeah, and she said to me, wow, Riz, so we've gone through this whole process of teaching her how to, set aside the money and make sure that, you meet the ATO obligations on time with enough cash. And as we were going through this process, she sent me a text after I sent her BAS one day, and she said, wow, Riz, thank you so much. That's the first time I've ever paid a BAS in full, and I didn't have to steal from someone else or steal from another resource. It was there for the BAS, and I paid the BAS on time, and that was it. And what I saw from that was the stress relief from the face, just going, wow, that's just amazing. And the second thing that I saw from that was, it's not the amount. It's not if it's 10, 40,000, doesn't matter. If she had that amount, the money there, that's all that matters. So if you have the cash set aside, you're ready for it, that's good. But obviously, we don't want you to pay more than you should be paying.
That's
make sure it's the right amount. So yeah.
And Riz is going to show us in a little while. Actually, we're going to go inside Xero, the software, and Riz is going to go super advanced and show you exactly how you can keep a track of how much GST is building up.
Yeah, I think this problem here, this number 3, not setting aside enough, it's a two-way. Well, it's not just one person. There's no one person to blame, because not setting enough tax or cash aside, meaning that you're using the money that was meant to go to the ATO for something else. Was that robbing Peter to pay Paul or something like that? You're doing that, but also it's the lack of knowledge of how much you should be expecting at the end of the quarter. If you kind of know, if I was telling you right now, hey, we're in the middle of the September quarter right now. If I'm telling you right now, you're going to pay roughly, not even the right amount, but just roughly $10,000 in BAS or in GST, you wouldn't dare and just spend that $10,000. You can kind of go, all right, I have a BAS that's about $10,000 coming up. Maybe I shouldn't use that $10,000 for the equipment just yet. Kind of budget a little bit better. So knowing your numbers is really important, and that's something that I'm going to go through later on in Xero.
That's right. And if you're setting aside that tax in a separate bank account, that means it's sort of out of your main business operating account. So you're not going to, buy that piece of equipment or, just spend it on stuff that you'll later regret.
Or it gives you a better inclination of, okay, this is how much I can spend. Let's not talk about how much you shouldn't spend. Let's talk about how much you can spend. And that amount is free of ATO obligations and BASs and GST and all this stuff. So it's actual cash that you actually have. And having that knowledge is super powerful.
Awesome. Well, I just want to remind everyone that feel free to ask questions as we go. I'm also checking Facebook to see if anyone's asked some questions live as we are. But no, nothing there. Alrighty, well, cool. We're going on to problem number 4. Back here. Which is the wrong business structure.
Wow.
So we touched very lightly on this before. We talked about trusts briefly, but what's a trust? Now, business structures are very close to my heart, and I'm going to literally. We're going to talk about how business structures affect the BAS or the tax that you pay. Now, in Australia, broadly, there's 3 types of business structures that you can choose from. The first is sole trader, and that's actually you going into business as a person. So that would be Ben Walker trading as Inspire CA. And then we're going to learn why that's not really a great idea. And then we've got the choice of a company. And a company, we're going to learn the benefits from a tax perspective, and it also gives you what we call asset protection, and similar with a trust as well. So trusts are a little bit more flexible for tax, and if they're set up properly, that they can also help protect your family's assets. So we've got a bit of a little table here. Sole trader up the top, and on the left, and then company in the middle, and trust on the right. And here's the tax rate for each of these entities. We've got sole traders who pay up to 47%.
Is that the individual marginal tax rate, isn't it?
That's the top rate of tax that a sole trader or a person can pay. Now, it actually goes up if you've got a HEC step. And I think you can go up another 8%, so it's at 55% tax. That is horrible.
Imagine if you work all these hours, like 80 hours, 70 hours a week as business owners, and all that money you make, half of that just goes to the ATO.
No, we don't want to imagine that, really. there are better ways.
Yeah, there are.
And one of those ways is a company. Now, companies pay tax at either 27.5% or 30%. Now you might be asking, hey, what's the difference between the two? How do we pay the lesser rate? Now, if your company is turning over $10 million or less than $10 million, then you'll be classed as a small business from the ATO, and you'll only pay 27.5% on your profit. Now, if you're a big business, like take Qantas, for example, if they haven't made ridiculous amounts of losses, they'll pay 30% in tax as a big business, that the ATO call. Now, trusts over on the right here, they actually don't pay tax. I said that earlier. So that doesn't mean that everyone can set up as a trust and then pay no tax, never. Trusts actually pay, they don't pay tax themselves. They give it to other people in the family group of the business owner, or other people or other entities as well. Other could be companies or charities, churches, and that sort of thing. Now, with tax planning, so what I mean by tax planning, moving down to this second line, is that there's things we can do with each of these entities apart from sole trader, because there's a big no there, to plan for tax. And that's what our wall behind us is the process of tax planning with our clients, to save them, in some cases, ridiculous amounts of tax. Now, as a sole trader, there's not much you can do to save tax. As a company, we're getting there. It's much better or flexible than a sole trader. But a trust is where the tax planning rubber hits the road. Now, it's one of the most flexible structures from a tax perspective. And just this bottom one here, it still protects assets in a meaningful way if it's set up correctly.
When you say protect assets, does that mean if, let's say, I run my business as a sole trader and for some reason I get sued and they want, compensation for that, I don't have the money, can they go after my house?
In certain cases, yeah. If you're not set up correctly, they can actually come after your personal assets, like the family home or your investment portfolio. But set up correctly, there's ways that you can fortify yourself from the risks of running your business.
I guess that's a whole bigger conversation, because there's two things I see here that's important. You want to minimize tax on one hand and also protect your assets on the other.
Exactly.
And the correct structure allows you to do either one or both or none.
Exactly. Yeah. Well, we don't like sole traders because they pay the top way too much tax, very little ability to plan for tax, and then no asset protection. You're just running into a battlefield with no bulletproof vest on.
Oh wow! I like that.
The
analogy.
Yeah. Now, I'd love to give an actual example of using these structures. Now, I'm not going to show an example where someone was a trust and then when someone was a sole trader and then they switched to a trust. I'm actually going to give you an example of a client we started looking after, and they were already structured as a trust. It's just the accountant they weren't working with. They weren't using it to the extent that it could be used.
So using it is as important as having it as well. You got to use it well enough for it to be effective.
Exactly right.
Okay.
And so just going through this one before Inspire, just jumping down to the bottom section here. If they were to continue using their trust how they were, they're in the transport industry, and they earned $1.6 million in profit in that year. Right. And the tax bill on that 1.6 would have been $744,000 in tax. So it's a lot of tax. And would I say it's reasonable? I think maybe it's okay if you worked it out as a percentage of the profit. But they weren't taking advantage over so many different things that you can do with a trust. So let's take this $1.6 million and they're actually giving money to churches and charities. So we made sure that their trust could do that, and also record it correctly so that they weren't paying tax on that money. They had a couple of children over 18 who were at uni or working. Not working. They're having children, and they were able to receive a distribution from this trust. Also retired parents, and so we were able to make use of that. And with retired parents, you do have to watch that it doesn't affect their Centrelink, because that could actually cost more to them than the tax it's going to save you.
Yeah.
Distribution to the brother who's at uni. We also set them up a bucket company, or we call it a family vault, a corporate beneficiary. There's a number of words for it, but excess profits can be paid into a bucket company. And then we also help them through setting up and contributing to their self-managed super fund. Now, all of these things, and this was in the 2016 financial year, all of these things took a tax bill of $744,000 down to $487,000. So they were pretty stoked because we just saved them, through our tax planning, $257,000 in tax.
What would you do with that?
What would you do with that?
Yeah.
That's
a few trips around the world.
Exactly, it's a generous income on its own.
That's a small business income right there. You're right.
Yeah. And not everyone earns $1.6 million in profit. I certainly don't. And if we look at the wall behind us, either did a lot of these business owners. So the thing I want to point out is that you don't have to earn a ridiculous amount of money to save a ridiculous amount of money in tax. On average, I think we saved our clients, it was about 18.5 grand this last financial year.
On average, yeah.
And profits ranged between maybe $50,000 and 1.6 million, but that certainly wasn't common. The way that we help our clients, and I hope you don't mind me sharing the process that we take our clients through, or if you were looking to explore working with Inspire, or you just wanted a second opinion on your tax. Now, there's two ways that you can learn or find that out. The first one on the left-hand side is we actually have this service we call a look under the hood, and that's a second opinion on your tax. And what we do there is we literally look at, it's like when a mechanic looks at your car, and they lift up the hood and they go, oh, what's going on with that radiator?
Yeah. You're obviously not a mechanic because the radiator's not in the hood. A radiator.
Hey, I'm not that bad. But, so we actually look at what your accountant has prepared previously, and then we give you feedback on whether there was potential tax that could be saved, and whether you can actually put that back in your bank. And I said earlier that more than half of business owners are paying too much tax, and that's because that's exactly what we find. So I think it's either between 7 and 8 out of 10 people who do a look under the hood were able to find them more than $500 in tax savings.
Right.
And we actually guarantee that. So it costs $500, and if we can't find you that in tax savings, that $500, we refund the money back to you.
It's kind of like, is there something wrong with me? No, I'm gonna go for a checkup. How much does it cost? $500. Okay. There's nothing wrong with me. Cool. Here's my $500 back.
Exactly.
So, yeah, it's a no-brainer.
Risk-free.
Risk-free.
And at least you'll have the peace of mind either way that you've either paid the right amount, or you're 7 to 8 out of 10 business owners and you are actually paying too much tax. And the other way that you can learn a little bit more about tax saving strategies is actually come to breakfast with me next Friday.
Yeah.
So we're holding a tax savings workshop where we cover 12 tax saving strategies, and it's $50, or it's actually free with a look under the hood. And the way that you can actually book that in is happy to share this link, but you can jump over to our website, and we've actually got this on where you can grab a ticket, $50 here, and hit the purchase tickets now. Now, if you are, so you're scrolling down, if you've got a hunch you're paying too much tax, we're going to show you 12 strategies to save you more than 20 grand in tax. We kick off at the Lord Stanley Hotel in East Brisbane, 7:45 for registration and a coffee, and we wrap up by 10 o'clock after we share those 12 strategies. So let me pop in to the chat box a little link there. If anyone is keen to to go ahead with that. Now, Arvind, how are you going, mate? It's been a long time.
Yeah.
Arvind has asked, can a distribution go to an industry super fund for the concessional contribution instead of an SMSF? What I'm going to do...
That's a big question.
It is.
Yeah.
So Arvind, I'm guessing that question was from that example before where we showed you that client put money into an SMSF. Now I'm going to take off my tax accountant hat and put on my self-managed super fund advisor hat. And obviously this is general advice, but you can actually do a concessional contribution from either a company or a trust to your self-managed super fund or an industry super fund. And it just depends on your situation, exactly what you've got to tell your super fund and how you pay that. But yes, the answer is yes, you should be able to do that if you've got a business that's producing profit and it makes sense to do that in your circumstances. So you don't need an industry super fund to make a concessional contribution. It could be that or an SMSF. Your second question was, what information do you ask for in a look under the hood? Now, there's three things we ask for. The first one is access to your Xero account, so we can literally look under your hood, see what numbers are happening, and that gives us some context to what happened in the financial years we're looking at from a numbers perspective. Now, we also ask for your previous accountant's tax returns and financial statements, because what is in your Xero file, unfortunately, sometimes is not exactly what the accountant or the ATO sees. So we want to make sure that both of them match up, and we've done what we can from a structuring and taking money out perspective so that we're not paying too much tax. Now, the third thing we ask for is 10 minutes of your time to fill out our Inspire alignment questionnaire. And what that is a number of questions that's asking you about your future. So the other stuff I mentioned is going to ask you about what's happened in the past 12 to 18 months, maybe we'll look at. But we want to know, where are you going and your family in the future? And whatever strategy we put in place there, we've got to make sure that makes sense to where you're heading. And I hope that answers your questions, Arvind. And I see, so your questions have come through. It's live, done.
Wow. So where are we up to now? Number 4 of the common mistakes, was that right?
I think we're about to go to number 5, actually.
Yeah, I think before we jump into number 5, it's almost 45 minutes in now. But what I wanted to check is just a little temperature check, if everyone's okay, and if you have any questions, feel free to shoot that through. But what we've gone through so far is kind of the stories behind the mistakes that happen every quarter, and what businesses do or don't do that cause them headaches during the BAS time. The next bit that we're going to go through is a bit more Xero orientated, and then I'll share my screen and run you through about the numbers behind it. So this is going to be a chunk of kind of how, if I was to put what this section is about, it's kind of like giving yourself a self-check, your business a self-check every quarter when the BAS is due. And this problem of not knowing your numbers is fundamental to the headaches that you have at BAS time, and it actually links into the other problems that you have, all the other mistakes that we were talking about previously. Just because knowing your numbers is such an integral part about measuring the performance of your business, checking if it's okay, if it's not doing too good, how much money should I be putting aside, all these questions that you usually have question marks on can be answered by simply knowing your numbers. And thankfully enough, in today's age, we have systems like Xero that keep track of all your numbers. And some of you may have seen this before. If you use Xero, this is the Xero dashboard, and that's what I'm predominantly going to be jumping into today, and just kind of point you towards where those important numbers are, what to look out for, and also what reports to look at. And it's going to be predominantly to do with 2 things: 1, your BASs, and 2, the business performance and how you're going, and kind of like have an assessment of this at this stage. Now, at this point in time, it's a good time to ask yourself before we go into this section is, how often do you go into your zero file to look at these numbers? And also, have you ever looked at it? Maybe, maybe not. What are the numbers that are important to me? Ask those questions to yourself. And also, if you have any questions for me throughout this session, feel free to shoot it through in the chat and I'll answer those questions for you.
Awesome. So we're going to switch over to, we're going to go live into Xero. Now we're not going to go into Inspire Xero like we did the BAS, but oh yes, I am still here, Xero. We're going to go into the Xero demo company, and Riz is actually going to walk us through some of the key reports that you need to look at to make your BAS Deadline a business lifeline. So I'll hand it over to you, Riz.
Oh, thank you so much, Ben.
So what's the first report that we should suss out when we log into Xero, and how do we get there?
Yeah, that's a great question. I might even take a step back behind that. Is that okay?
Yeah.
Yeah, so with the reports, that's the first place I want to jump in and kind of look at everything where the numbers are. But the first thing I want to kind of go through is this idea of the dashboard. Now, the dashboard is a good place for a snapshot of what's happening into your Xero file. Now, the most important bit here is just checking that your reconciliations are done. Now, every BAS time, that's what your accountants will ask you to do. Hey, can you please reconcile your books so we can do your BAS or prepare your BAS? The reason why that's important is it's essentially, I'm not going to go into too much detail, but it's essentially completing your bookkeeping to date. Why that's important is because the data that is unreconciled is raw data that you're not telling Xero what it is. Is it an income, expense? Is it, you know, does it have GST or not? You're not telling Xero yet. You have to complete that before we can do any meaningful examinations.
And that's how you might underclaim GST and pay too much on your BAS, isn't it?
Absolutely, yeah. So there are issues in here that are important. So if you tick that off, if that's Xero, all your bank accounts have been reconciled, then only we can look into the reports. Awesome. So in other words, keep that as low as possible, because that means if that's outstanding, it means your numbers are not up to date. If you don't have up to date numbers, you can't make up to date decisions. Cool. So that's the dashboard. That's what you want to look for. The first thing I want to jump into straight away is this thing called a profit and loss. I might just open a new tab if that works.
Profit and loss report.
Yeah.
Awesome. So,
it's working.
What does this report tell us?
Yeah, so it's as the name is, it tells you whether you made a profit or a loss.
Yep.
So in simple terms, I'm just going to go very basic first. It's the income that comes into your business and how much expenses that you incur in your business. Sorry, that's the income bit, and how much sales. Yeah, like sales and stuff like that, and any cost of sales, which gives you a gross profit, and from that gross profit, how much of it is spent on operating expenses, or some people call it overhead expenses. Then you get what we call an operating profit, and also there's that non-operating income bit, but that's just other income than sales, nothing to do with your business, so it's not operational income. So yeah, so this is the sample data we have from the demo file. And what I like to do, the first thing is you want to make sure that these numbers are relevant to you. What that means is check that the reports are in the correct date period, first of all. If you're checking for, let's say, the recent June quarter.
Yeah, can we see, if we were going to have a look at June, how would we change the month so we could have a look at that?
Perfect. Now, what I like to do, there's many different ways to do it, but what I like to do, and the easiest way to do it, is this compare periods. Jump into compare periods, jump into June, keyboard, I might just type that in actually.
There we go.
Yep, June 2017. That's the recent June, and then we're going to compare the period as 1 month, but we're going to compare 2 months before, so that makes it a quarter. Now, what I like to do as well, so I just click update a bit too quick, is untick show year to date. YTD means year to date, means the full year to date. Rather, I'd like to know the total of the quarter only. So April, May, June, and that's the total. Now, the first thing I see here is it's a shorter profit and loss. It means there wasn't much that happened during this quarter. There was some income and some expenses, and there wasn't all those other funny bits.
So why is there zeros in April?
Zeros in April, perfect, great question. If we didn't run this report comparatively to each month, we wouldn't have seen April and we wouldn't have seen those zeros there. What that essentially means is in April, this business did not exist.
Okay.
So there was no income, nor was there any expenses. So it only started in May and June. Now, coming back to the knowing your numbers part of it, what's so important about the profit and loss? Everyone loves this part, sales. Hey, how much sales did we make this month? Hey, oh, cool, we made 100,000 or whatever. That's the part everyone kind of keeps track of. But how much of that?
You know what I love about this?
Yeah.
Is that in May,
yeah,
there was $4.5 grand or so in sales, and we in this business went 4 times that. Roughly.
Exactly.
About 18 grand. Now, what happened with profit?
Interesting. So, thank you, Ben, for that comparison. This is what we're trying to get you in training of. Not just looking at June. Hey, June was a great month. I'll tell you, June was actually the worst month compared to May. If you're looking at profit.
So you'd rather 12 Mays than 2 Junes.
Correct. If you had, that's correct. If you had 12 months just like May, you'd have $12,000 of income, roughly. And that's just a comparison there. If you had 2 bad months like June, that just outweighs May straight away. So 6,000 and 12,000 there. So they're getting a bit complicated. But what I'm saying here is look at the trends. That's what we're looking at. So a part of knowing your numbers is not just looking at one single number and going, hey, I had a good month. No. Let's have a look here what happened. Oh, so you hired some new team members. There's $20,000 of wages and salaries there. Oh, that's okay. So that's at $20,000 of wages and salaries. And we can see that they made quite a loss in June. So a part of knowing your numbers is comparing the trends between the months and also looking at a bigger picture rather than just looking at your sales account. Look at your expenses, explore what's happening in your business. Now, at this point in time, most business owners, some business owners may say, wow, I haven't looked at my profit and loss in the last month or in the last 2 months, or my last profit and loss is when my accountant showed it to me. And that's a habit we would love for you to get out of and kind of be focused more on knowing your numbers here, because that really relates to what those BASs are every quarter. Because it gives you an opportunity. If you have to prepare the BASs anyways, these numbers are updated because you have to reconcile them. It's an opportunity for you to go in and just run the report and just go through and see how the loss or profit and loss is going there.
Yeah, and just one thing I wanted to show you, because so Riz, you mentioned that we look for trends.
Correct.
Yeah, so we want to see if there's whoops, sorry. I'm actually going to change the months here because I saw something interesting before. So yeah, we've got a couple of months of zeros, and then the business looks like it started in May, and then it went 18 grand 9, so it halved in July. So a bit of a volatile business from the looks of it. But the other thing that caught my eye was this here, legal expenses.
Wow.
So the trends is one thing, but we want to make sure that any weird looking things on the profit and loss or anything big or out of place, we actually know what it is. So if you do run this report for yourselves and you see a big number like this, click on it. And then you can see what it was for. Now, Ridgeway Savings and Loan, Bankwire, who knows what that is? But that's the Zero demo company. But make sure, if you do run this report, you know the things that are happening in your own business, and not just looking at the report and going, oh, okay, I made a loss or another loss or a profit. And as Riz said as well, not just going, woohoo, sales are on track. So what about all these expenses?
How does it tie into the BAS webinar we're talking about here? It's the fact that we're turning a problem into an opportunity. Your BASs have to be prepared, your books have to be updated. Why not add in a part of that to know your numbers as well? So the accountant goes, hey, here's your BAS, and you can look back into your zero file. Cool, what's happening in my business as well, not just about GST.
Yeah, that's great.
Cool.
Alrighty.
We're running through the next report here.
Yeah, sorry, I'm sneaking this one up.
That's okay.
We've got one question. No, that's Arvin. No worries, mate.
Cheers, Arvin.
Alrighty, so we've also got this balance sheet. So what's a balance sheet?
It's not as simple as the profit and loss. It doesn't show you the profit and loss, doesn't show you the balance sheet. Well, it does. It shows you the balance of all these accounts here. To put it in simple terms, let's look at the big headings. There's assets, liabilities, and equity. What that means is the balance sheet shows you what assets your business have, what you own, and also liabilities, what you owe. Does that make sense?
Yeah, so it's kind of like maybe things like cash in the bank or what you own, maybe the furniture in the office or the cars,
Correct.
and then any debt or things you owe on those things, like a credit card or a, what have they got here? They've got a GST bill.
Yep.
Okay, so yeah, so what you own and what you owe.
Correct. Yeah. So what you own and what you owe, that's the important part. So when you run through these numbers, what you want to look for more so is that the accuracy of those numbers are there, because it essentially shows if you're imagine counting your money in your wallet. If you think that your bank account balance says that you have $100, and then you check your bank and you see, well, actually, no, I don't. I only have $10. There could be something fundamentally wrong in the bookkeeping here. So you want to make sure that your assets are correct. You want to make sure that those numbers are correct. And if they are, which they should be, what you can also assess is, in this case, it looks like they're in an overdraft position. That's a negative number. What that means is the cash that they have is not enough to supplement the business. And they've actually had to go into an overdraft position. So it gives you an idea of how much cash you have in the business and if you can still keep chugging along, and make sure that you can run those business. And the next bit here is the current asset, for instance. It's accounts receivable. A lot of people think that, oh yeah, I have a lot of people owe me money. It means that I made a lot of sales. It's a good thing. Not technically. So you can have a lot of sales, but all that money hasn't come to you yet. What that means is it's still stuck in accounts receivable.
And so that means that this business is owed $16,000.
Correct. And that's not nice, knowing that, because cash is the lifeblood of the business. If you don't have cash, you can't operate. And you can see this. It's the problem for the business here in this demo company. The sales would have increased between July and August, but those sales were not collected. Hence, you can see that the cash, they don't have cash. They had to go into an overdraft position. So this is the things that you can look for. Those are one of the trends that I just showed you, and those are the things that you can look for in your business as well.
Awesome. Thank you. And then obviously just lastly before we go to the next report, then yeah, we want to make sure that these things that we owe, at least we're aware of them. And this historical adjustment, if you do see that, then you need to have a quick chat to your accountant or bookkeeper, and just get them to explain what that historical adjustment is, because yeah, we shouldn't see things like that on the balance sheet.
That's pretty much an accounting thing.
Now, the last report we can go through is, let's have a look at the, where's it hidden away? The budget variance. Budget variance report.
Awesome. This is probably my favorite report.
This is your favorite? Wow,
this is my favorite report. There's a bit, the minute I show this, a lot of people go, oh, too many numbers, turn it off.
Yeah, there is. Well, how about we turn off that column?
That's good.
So we're down to about half the amount of numbers.
Yeah, not too scary.
What I see about this report is that the other two we looked at had just blue numbers, and this one's got red and green. So yeah, it's not Christmas time, but could you explain why that is?
Sure. So right now we're looking at the month of August, guys, and month of August has not finished yet, right? So different from the profit and loss, that was looking backwards. We're looking at our performance backwards. So if you're driving in a car, you're kind of looking at the rear view mirror where you've been. The budget is kind of like looking throughout out the window itself, looking forward, because you want to budget what happens next month. And in this case, we're looking at the budget for August. So in the month of August that hasn't ended, we have a column called actual and a column called budget. Now, you're going to set your budget up for the month of August. That's the target or the goals that you want to achieve. And then the actual is the numbers that actually happen throughout August. Now,
and so where this business, like let's imagine we're this business and it's the 17th of August today.
Yeah.
And we're sitting at $12,700 in sales.
Mm-hmm.
Now, this shows us how much we've got left to go.
Correct. Yes. So it's saying what I can see from this budget here is it's trying to achieve almost like a break-even point, not even profit point. But what it's saying is, look, guys, we need to achieve $20,000 in sales so that we don't lose money, maybe lose a little bit.
Yeah, which we wouldn't recommend budgeting to make a loss. But...
Exactly. Always budget, you know, for your targets, realistic targets and goals. But 12 grand, so we got 8 grand left in sales for the next 2 weeks before the month ends. So you can see this variance here. That's what it is. That's your question, Ben. Why is it red? Yep. Red means no bueno or no good. Okay. It means that you did not meet the target. So you're down by 36% in sales. So you need to get another $7,000 in sales to meet the budget.
Cool. So if this is set up correctly, we can log in to this report throughout the month, and it's going to give us immediate feedback on how we're tracking.
Absolutely. And that's all live. That's what's beautiful about Xero and live bookkeeping is if you look into the expenses, it's the opposite now, is that if you keep your expenses as low as possible, it's actually green. So you budget that cleaning fees will be $170, but actually you pay $155 only. So you're down by 8.8%. Green, so lower expenses, higher income is good. So that's where the red and greens kind of come along to. And yeah, so that's the budget that you want to look at every month. And again, tying into the BAS, these numbers will be updated every quarter when you do those BASs.
That's it.
Why not just jump into it and have a look, know your numbers?
Yeah. So whoever's listening on Zoom or even on Facebook Live, we don't actually have enough time to go into what we call a budget manager and show you how to do a budget. But I'd love to gauge your interest in actually a separate webinar or Zoom session that we actually do that. So if that's something of interest and to actually run this budget variance report and it to actually work, then I'd love you to let us know by popping a message in the chat box or even shooting us an email letting us know that. So yeah, we're only going to do it if there's people who are keen to come along.
It is a huge part of it, and budget managing is definitely important. Cool. And that's kind of like how you know your numbers at the end of the day.
Awesome. Thanks for that, Riz.
That's okay.
And you are the champion of Numbers A team. So I'd love for you to just walk everyone through the 3 people you need on your numbers team.
Right. Okay. Well, the reason why, thank you so much for that, Ben. The reason why there's this concept of your Numbers A team is that you want to make sure that numbers is kind of the scorecard of your business. And as let's say a sports person, you'd have a physiotherapist, you'd have a doctor, you have a dietitian that tells you, hey, you need to do X, Y, and Z to make sure that you can, perform well in your field. That's the same thing like your numbers here. We have accountants, bookkeepers, and CFOs, and you can see those circles there, they overlap each other. Reason why is if you are a big business, usually you'd have even separate departments for that. But in smaller businesses, one of those 2 roles could be the same person. And I'm going to go through a bit more detail on what each of those roles mean and why they're important, why you need your A team. Now, let's start with the accountant. Let's start with the bookkeeper, because that's where kind of the base of everything starts. Bookkeeper, generally everyone knows the bookkeeper, what they do is they go into your Xero file and then they reconcile your transactions and make sure that your books are up to date. And then they pass it along to the accountant or pass it along to the CFO for their own analysis or their own work. So the accountant prepares the BAS, the CFO looks at the reports. But that's what the bookkeeper does. But that's such an essential role because, as I was talking about previously, if you don't have a qualified bookkeeper, the biggest problem I see is data entry that goes way wrong and actually costs you money. Can you imagine that because of data entry, you're paying more? That's not worth it at all. And how much is a bookkeeper go for these days, anyways?
You can get bookkeepers for $50 to $80 an hour for a good one.
Yeah. So if you're thinking to yourself, I don't need a bookkeeper, I'm a small business. I implore you to think again, because a bookkeeper, it is a good investment. And the other part is time. Yeah. How much time do you have as a business owner to sit there on a Sunday night, and you on a Sunday and you're just punching away reconciling numbers? I always say, I always say, when I was a bookkeeper back in the day, I always say to my clients, I said, look, leave it with me because you're trying to save the world and I'm just trying to keep the books. So go save the world, you know.
And you are helping them do that in the process.
Exactly. So it is a good investment in terms of time. And again, you said a bookkeeper costs somewhere, let's say $50 an hour. Is your time worth more than $50 an hour? If it is, every hour you're spending bookkeeping, you're actually costing the business money.
And not only that, you could be doing it if you're not a qualified bookkeeper or you haven't got training on it, and then you could actually be getting the numbers wrong. And so the numbers that the accountant are using and also the CFO are using could be making, making assumptions and advice to you based on, on the wrong numbers, and that could be, we've seen that be very dangerous.
Yeah, it is the integral part to everything. It's kind of like a domino effect as well. So from the bookkeeper, let's move to the accountant. That's important. Need a bookkeeper. No, hands down, that's our rule. Next thing is accountant. What do the accountants do? What's their role and responsibilities? Well, we here at Inspire, we want to look past of being just an accountant. What we think an accountant should be is the person that keeps you accountable. Accountable, and also make sure that you stay out of jail with the ATO. So we make sure that all your obligations with the ATO are met, but not just in the manner of basic, like, okay, we meet our obligations, we lodge our BASs and tax returns on time. What I mean is, it's also there to service you in a way where it makes your life a lot easier with the ATO. Like here at Inspire, what we do is we implement all this time-saving technology like webinars and you got online meetings and all this stuff.
You don't send your paper, you sign it online and all that.
Yeah, so making your life easier is also one of the part of the accountant's job, but mostly it's that tax and accounting bit where we prepare your financial statements and tax returns at the end of the financial year, but not just preparing it, that's a normal accountant, preparing it to the degree that you're paying the right amount of tax that you're supposed to pay, and also having the financial statements that you understand, not just for some accountant to read, you as a business owner. So the accountant is kind of the integral part of also educating you behind what's happening in your business from a tax and accounting perspective.
And a great accountant will also save you more, like these ones that are more tax than they actually cost you in accounting fees.
Yeah, absolutely. And it shouldn't be a cost center in accounting. We don't believe that should be it. A tax on tax, people like to say. Accountant should add value to your business, not take away. Add stress and take away money, and that shouldn't be it. If you have that as a problem, I implore you to rethink again and see if there's other better avenues. So now that's the accountant and bookkeeper. They work together, they talk to each other, going, hey, what are the numbers? We need to prepare stuff with the ATO. That's kind of the CFO. All right. The CFO is the internal accountant per se of the practice of the business. Sorry. So what I like to think of it as is like a coach almost. So what you want to do is you put your CFO hat. So you as a business owner, you can be the CFO as well. So you put your CFO hat and you just do what we did just then. Go through the numbers, look at the trends and make sure the numbers are okay. What are my targets? Where I want to be? Am I on track? Those are the things that the CFO does. And they just want to make sure that you what goals you set and where you are you on track to get there? And also you make plans to make sure you get there. And most of the time in small businesses, you don't have a dedicated CFO. The business owner is the CFO. And the CFO talks to the bookkeeper because the bookkeeper has to prepare the books for the CFO to rely upon. And if those numbers are not true and correct, the CFO may make decisions that are incorrect. For instance, if we were looking at the profit and loss, we could tell whether, or the balance sheet, we can tell whether, is it a good time to buy that new equipment? Should we explore franchising? Making those big decisions in the businesses. And all those decisions are based on numbers. So again, knowing your numbers is so important, and having a right bookkeeper to make sure the numbers are correct, it's integral to your business. And to wrap up, you see all these three roles coming along here. We have the bookkeeper, CFO, and accountant. If you have this A team here in your business, it's safe to say on a base level, you at least know where you're going, how to get there, and you keep yourself accountable, and also making sure that you don't pay too much tax and the numbers are easy to rely on, you know.
Should even stay out of jail too.
Yeah, absolutely. And Ben, you yourself, you played the role of a CFO for your own business, and you look into your own business. Did you have anything you wanted to add in there?
Yeah, sometimes the role of the CFO is actually better coming from someone else, and the reason why that is because when someone else challenges you on are you spending too much on certain things, versus you asking yourself that question, you could get too comfortable with stuff that you're effectively wasting money on or you don't need. Your business doesn't need to sort of keep your customers happy.
Because you as a CFO might have a conflict of interest,
Yeah.
and you look at your own books and go, I'm doing well. It's just like us looking in the mirror when we're trying to lose weight. We go, nah, we're still good looking. But you know, in actual fact, there is high risk of things happening in there where a PT or a doctor might be able to tell you better. So is it right? Is it right to say that if I have, let's say, a cafe business, I can share, you know, I can find someone who I trust who maybe has a cafe business as well, and kind of keep each other accountable?
That is definitely a way to do it. Absolutely.
So you kind of go, hey, this is what I'm doing here. This is working, and I see that you're not doing that. Hey, why don't you do this?
Yeah.
You know, you have someone else to work with. It's always good.
Absolutely. Well, thank you everyone who's joined us for listening along. And one thing we want to do as we wrap up, so we're going to wrap up well and truly before 1:30, and we're going to leave it open for some questions if you still have any. But we really want to thank you, and to celebrate you joining us on the webinar, we've actually given a family in Malawi access to life-changing water for a week. And we do that thanks to our partnership with Global Giving Initiative, Buy One, Give One, or B1G1. We've got a belief that businesses have the power to change lives, and just from you attending this webinar, you've given that week of access to water, and we can make a massive impact. And we've actually got an ambitious giving target this year, which I think we launched in March or April. And our goal, so we set the Save Tax campaign that happened in April to June. We're actually setting a giving campaign, which is to give 1 million days of access to water to a family in Malawi. I just want to really acknowledge you and thank you for adding to that.
It's not us that did it; it's you guys, really. And thank you so much for contributing to the world. I think, like, I believe in what Ben believes as well. Businesses have the ability to make impact in the world, and how great is it? You're learning about business, learning about your numbers in business at the same time you're helping someone halfway across the world. I think we deserve a round of applause.
Yeah, thank you.
Thank you so much, guys.
Yeah. So very, very happy. Riz and I are happy to take questions about anything we've chatted about, including if you'd like to know more about B1G1, we love them, and went to a conference there in the Gold Coast in July. So it was really good to catch up with so many like-minded business owners. But so we're an open book here. We'll be taking questions for the next 8 minutes.
Yeah, let's check if there's anything.
And we can, I guess, a final thank you, and I hope you have a great rest of the Thursday. And for the people who work in Brisbane, I hope you had a great public holiday yesterday. It feels like a Monday today, doesn't it?
Yeah, it does. It feels a bit weird.
Yeah, no, it's definitely not a bad thing.
Nah.
Yeah. Alrighty. Well, I'm going to go and check Facebook as well as we go through. Not that one. Alrighty. So, looking good, lads. Thank you, John. Chief. That's it. Love the wall. Thank you, Harvey. Cool. Well.
Looking at ourselves.
Exactly. Alrighty. Well, if there's no other questions before we'll wrap up. Thank you, Ingrid.
Thanks for joining, Ingrid.
Really appreciate
and
you.
Thank
gratitude.
Bradley, Deborah, and Robin, Tori. Thank you so much.
Yeah, thanks again for joining, guys, and hope to catch you at the next webinar or at the even the Save Tax or the 12 Tax Saving Strategies Breakfast next Friday, the 25th. Thanks, Bradley. Hope to see you soon, mate.
See you guys.